So we start with Andreas Yiasemides, President of the Cyprus Investment Funds Association. And the title of our programme is There is Money. Will it reach the markets and how?
Okay. Good morning, everyone. It's a great pleasure and honor for me to be here in the very prestigious event here in COVID-free London, or better, restriction-free London. So it's a pleasure to be here with you and being part of this interesting panel. Undoubtedly, humanity, as well as the entire world economy, has been faced with unprecedented challenges from impact of COVID-19. In the years since the outbreak, the world has changed. Our lives have transformed, and the same is true for our economies. The stock market has been very volatile as a direct effect of COVID, and the global stock markets have experienced some of their worst points in the recent history. The fundamental trends have accelerated, propelling some companies forward at record speed, while others, the impact of COVID has proven to be catastrophic. As we are all trying to recover from the effects of the global pandemic has had in our daily lives and are making efforts to regain a sense of normality, the business world is also shifting its focus on recovery and new opportunities. In a recent PwC survey, the vast majority of interviewed CEOs have predicted a stronger global economy in the coming years. We can see governments starting to put in place recovery and resilient plans, focusing on digital transformation and transition into the green economy, as well as putting social and health issue in the forefront. Although this is always a cliche, undoubtedly the COVID-19 crisis has accelerated the shift of the developed world to digital. New technology and changing consumer preferences and disrupting retail worldwide, putting pressure on retailers. Leading retailers around the world are making structural and organizational changes, building the critical capabilities needed to adapt or create new technologies that address their customer needs. These organizations offer examples to other retailers of how to reshape, rethink, and reinvent traditional business models. What is more, digital technology has changed how consumers engage with the product and brands. Millennials have interacted with brands on social media or on brands' website, resulting in niche brands which can compete in the retail world, pricing being more transparent, significant increase in brand choice, and of course, a decline in brand loyalty. The changing retail market has created a number of opportunities for adaptation. The first relate to the financial ecosystem surrounding the e-retail market, namely the accelerated shift towards e-services and electronic payments, and away from traditional ways of transacting and banking, a shift which I would expect to continue in the coming years with the rise of fintech banks. For those of us who are in the services industry, in my view, what is important to understand our customer values post-COVID and take active steps to develop a customer purpose-driven action plan that will enable us to tailor our services and our customers' preferences and experiences based on these insights. Therefore, strengthening data management and analytics help us to understand customers and continuously improve customer experiences will be the key, not only for predicting customer preferences, but it will also enable us to provide our clients with greater value. This will in turn allow us to draw more value from our customers in an effort to rebalancing the equilibrium. This shift to digital servicing is also expected to be amplified by the volatility that exists in the supply chain. We know very well that there is an issue in the input availability, transportation, labor, and other, which unfortunately will become worse with the recent Russia-Ukraine developments. Urbanization, or better, return to urbanization, is another trend I'm confident will drive growth and generate opportunities globally. As we are exiting from the continued lockdowns and returning back to our normality, cities, and especially mega cities such as London, shall start to be repopulated, and the property markets globally are anticipated to have a positive effect as a result of this. The same is, of course, true for the vacation travel and the tourism industry, which are slowly starting to make a comeback after a prolonged period of downturn. Another emerging opportunity we have certainly started to witness is a shift not only of consumers, but investors and organizations towards more sustainable and green-friendly products and investment. For example, a McKinsey study suggests that in 2030, demand for green steel in Europe could be twice as much as the available supply. Shortages of recycled aluminum and plastic are to be expected. By planning green material sourcing strategies, companies can achieve immediate emission reduction and sustain progress toward long-term goals. Extending this into other industries as well, and considering the fund sector and the various EU regulatory initiatives, such as the upcoming taxonomy legislation, we should expect to see a switch on how businesses operate from an environmental, social, and governance angle, and especially in investments that they choose in order for this to be ESG compliant. This will be matched by pressure to be imposed by the regulators to comply with the ESG regulations, and also by investor shift in demand for underlying investment policy to score higher on the green and sustainable initiatives. Finally, closer to my area of expertise is the field of alternative investments. With inflation at its highest in decades and interest rates set to rise, I would expect opportunities to arise in the sphere of alternatives as they represent a large set of complementary investment solutions. Long-term investment objectives, as we all know, for investors, historically revolve around equity risk, and this has been traditionally considered the main source of financial wealth creation. However, asset managers are expected to embrace other asset classes that can diversify the equity risk and smooth out some of the impact of the periodic market volatility, such as the one we are experiencing now. The opportunity to diversify investments in an effort to have fluctuating risk-return combination across asset classes has made alternative investment funds, AIFs, a viable proposition for family offices and high net worth individuals. In fact, there is a visible appetite among investors toward portfolio diversification beyond traditional equity and debt classes and improve return. This optimism is driving investment in AIF space and has turned them into an alternative investment asset class. AIFs have indeed emerged as an effective investment instrument for wealth creation as well, thanks to standardization and obviously the detailed information on AIF structures. As AIF do not correlate with the stock market, they help investors alleviate volatility with robust diversification and inflation hedging. The rate of return prospect in AIF is higher than of the traditional investment avenues. As such, AIFs can be an outstanding investment option for generating consistent, relatively higher returns with relative convenience and safety. I'm very happy that I heard this morning Mrs. Lazarakou mentioning that AIF industry is booming also in Greece. Is a fact that we have seen on a global scale. In Cyprus, actually, we have established and we have introduced a very flexible EU-compliant fund legislation for alternative investment fund in 2015, and since then, we have seen a remarkable growth of 300% in the asset under management. At the same time, we have managed to attract big international players to establish a structure in Cyprus. I'm talking about fund administrators and custodians. Obviously, Cyprus can be the gateway of Europe for Israeli, Middle East, and Asian fund managers, providing and offering a cost-efficient solution at a very transparent and regulated way. I think Cyprus has all the ingredients in place to continue growing as a reputable EU fund jurisdiction. Being mindful of the developing landscape, both in coming out of the global pandemic and also entering in another troublesome time with the war outbreak between Ukraine and Russia, as business leader, we certainly navigating difficult waters. With this in mind, we cannot ignore the window of opportunity that we have to reinvent ourselves and our businesses and look at the trends that are expected to shape the economy. Today, I have only touched upon a small sample of opportunities that are available in the markets. And as closing remark, I will leave you with this thought. We know from analyzing previous crises that the momentum with which businesses emerge from a downturn determines their course for years. Companies that will manage to come out stronger keep outperforming, while the latecomers continue to lag. Thank you very much for your attention. Thank you.
Thank you very much. And now Demetra Kalogerou, formerly chair of the Cyprus Securities and Exchange Commission.
I have some slides as well, just to... This is the... Just to check before. Okay. All right. Ladies and gentlemen, good morning. It is a great pleasure that I am here with you today. Many thanks to the organizers for giving me the opportunity once again to participate in this panel discussion, reaping the fruits of recovery, opportunities and money. This is a panel. So I'm going to focus more again in Cyprus, but on the Resilience Fund that you heard from the morning up to now. And I will say this. First of all, the coronavirus pandemic has significantly affected the European economy, causing a knock-on effect on workers, households, small and medium-sized enterprises, which are the backbone of the European economy. The pandemic crisis has highlighted the urgent need for cooperation between EU member states in order to ensure the viability of businesses and at the same time protect the vulnerable groups. The EU, as a priority, is promoting the green transition, the digital transformation, and the strengthening of the resilience and sustainability of European economies and societies in order to tackle the effects of the pandemic. To this end, the EU approved a package of 1.8 trillion, which is a huge number, which includes the EU budget for the period 2021-27, and of course the Recovery and Resilience Facility Fund, Next Generation EU, 750 billion euros. Next Generation EU Fund is a temporary emergency recovery instrument and which will repair the immediate economic and social damage caused by the COVID-19 pandemic, kickstart the recovery and prepare for better and greener future for the next generation. However, this funding, despite being strictly necessary for Europe's short-term recovery, I believe will not be sufficient for the long-term sustainable recovery for the economy, given the size and projected duration of the financing needs, especially now that we are facing another economic crisis due to the invasion of Russia and Ukraine, which will intensify supply disruptions, push upward pressures on commodity prices and other goods, limiting growth prospects and increasing inflation further. To access these funds, member states must submit a recovery and resilience plan to the European Commission, which will check its alignment with EU priorities and the country-specific recommendations. The member states must allocate a minimum, you heard before, 37% to climate investments and reforms, and a minimum 20% for digital transition. Now in Cyprus, the total funding will be 1.2 billion, for which 1 billion will be for grants for different SMEs or any other company want to apply to the government for these grants. 200 million for loans with investment allocation, around 41% in green projects and 23% in digital projects. And this is expected to positively affect the output and employment, of course, in Cyprus. There is a clear consensus that we need to build a financial system that supports sustainable growth and redirecting activity towards green and digital sectors. A lot of money will be available and must be used productively for investments and to support reforms in order to strengthen growth and transform our economy. The three pillars that Cyprus must focus are, of course, digital transition, green transition, and social cohesion. I will just talk about the digital transition first. Is a significant portion of the next EU funding will be allocated to sustain a digitally focused growth economy. It can increase its competitiveness by introducing innovations that enhance citizens' welfare and support economic resilience by building a real data-driven economy as a catalyst for innovation and job creation, using RegTech solutions or artificial intelligence solutions for analyzing big data for quick screening. Supporting improved connectivity, say go to 5G network, enhancing the digitization innovation of public administration, including judicial, healthcare system, and land registry, encouraging the digital transition of enterprises. The COVID-19 crisis has brought the role of technology into the spotlight. The need to digitize processes has gone from nice to have to mandatory to all types of enterprises. Most of them are still working remotely or using the hybrid models. Improving capabilities in crucial sectors like the financial sector, which is the largest user of digital technologies in Cyprus and represents a major driver in the digital transformation of the economy in leveraging digital capabilities. For example, artificial intelligence, using cloud computing, cybersecurity, now it's a must, digital identification for AML purposes, distributed ledger technologies, usage of blockchain technology on cryptos, on digital securities and ICOs, adapting the education systems to support digital skills. Now, the green transition, the EU has developed a new strategy to address climate and environmental challenges that will help it transition to a modern, competitive, and resource-efficient economic model. I think this is where we have to focus most, especially now with the current economic crisis due to the war in Ukraine, which has already affected the prices of commodities, especially oil, coal, and gas, given that most of the countries rely on the importing of fossil fuels. The green transition must be accelerated so that Europe becomes less dependent on fossil fuels in the future. The European Commission actually has proposed the Repower EU, an outline of plan to make Europe independent from Russia fossil fuels well before 2030, starting with gas, seeking to diversify gas supplies, speed up the rollout of renewable gases, and replace gas in heating and power generation. The new generation EU will play a key role in making Europe the first climate-neutral continent by investing in future-proof clean technologies, improving energy efficiency of public and private buildings, promoting sustainable, accessible, and smart public and private transportation, enabling a more circular economy, supporting the transition towards renewable energy sources, and the capital markets. The financial industry can help, has a role for climate change, in order to channel capital of funding towards green, social, and sustainable investments for more resilient and greener economy. As you know, the package that already mentioned by Vasiliki, which includes from Europe the Sustainable Finance Disclosure Regulation, SFTR, taxonomy regulation, and low carbon benchmark regulations are all regulations for the finance sector. In Cyprus, we are yet to see a large-scale shift towards green investments. There is a lot of work to be done in order to see that. There are some alternative funds, though, with an investment policy focusing on environmental, social, and governance factors. If I remember correctly, around 30 million out of 11 billion funds under management have a sustainable green investment strategy, which is indeed a very promising step towards the right direction. And the social cohesion in Europe of tomorrow, needs to reduce social inequality and disparity to create a more unified model. The New Generation EU will support medium-term investments and reforms promoting social resilience in EU member states, aiming to reduce social disparity by ensuring a homogeneous level of services in all EU citizens, improving labour policies, modernising labour market systems, supporting social inclusion and reducing social gaps, investing in modern social and educational infrastructures. In addition, though, to the New Generation EU funding that I already mentioned and analyzed, Europe should continue to progress towards completing the capital markets union, which will integrate all the 27 national capital markets in order to improve the allocation of capital in Europe to support recovery and future growth in the longer term. The Capital Markets Union is the EU's plan to create a single market for capital. It provides new sources of alternative financing for businesses. Like the fund industry already mentioned, we already established it from 2015 up to now, and the growth is substantial. And this is an alternative means of financing because you can find investors and then allocate these funds to the different sectors of the Cypriot economy and elsewhere. So this is important. The Capital Markets Union provides alternative funds of financing. The other is the crowdfunding already mentioned from Vasiliki. We already have it in Cyprus, and we are waiting for the EU one to transpose it into our national legislation. And I think this is another way of financing the SMEs through crowdfunding. Also, we have created the growth market. The growth market is to help, again, raising capital from SMEs with less burden procedures, less burden prospectuses in order to raise capital, and also less transparency requirements. And if I remember correct, insider information requirements. So Europe is moving towards supporting the SMEs, giving these facilities to raise capital. All these will increase options for companies and for savers to make the economy more resilient. So it's not enough having funds from Europe all the time. You need to create capital markets and advance. At the same time, I believe the European Commission must complete the banking union. This is another issue, without delay, because the introduction of the European deposit insurance scheme, which will replace national insurance schemes, will create a strong pan-European guarantee for banks' deposits for up to a certain amount during financial crisis, regardless of the member state which each bank is located. Achieving this goal is particularly important in a possible new economic downturn after COVID-19 pandemic. So all the above issues need political decisions to be taken and consensus among 27 member states. I believe that it will take a few years for Capital Markets Union and Banking Union to be implemented, but it will definitely lead to more integrated Europe with more robust, innovative, and sustainable economic and monetary union. Thank you very much for listening to me.
Thank you very much. And our third speaker is Anna Kalliani from the British Hellenic Chamber of Commerce.
Good morning, distinguished guests. Thank you, John. It is a great pleasure being here today after 2 years. First of all, I would like to congratulate the economist and Nektaria Passarivakis for this great event. It is understandable that the Ukrainian crisis and the related energy crisis have lowered the initial expectations that were optimistic for growth this year, not only in Greece but internationally. And this was not something that had been predicted. What I would like to emphasize is that especially from now on, we have to realize that we will live in a highly volatile environment, and we will have to cope with and overcome various smaller, bigger or smaller crises and unexpected events. We do understand that investments need a business-friendly environment and stability at various levels. Political stability and taxation indicatively. Within this highly volatile landscape, the questions are how global liquidity will be affected, Will this liquidity reach the markets? Which parts of the markets, and under what conditions? Certainly, depending on the duration of the crisis, global liquidity may be affected negatively in various ways. Valuations may have to be adjusted to reflect the prevailing risk to value conditions. Maybe now we have a wait-and-see reaction. But even in challenging times, liquidity still exists, even at lower levels, and directed where it will find opportunities. Let's think what we have achieved as Greece the last 2.5 years, 2 of which we have the pandemic. The Greek government has made a big effort, which is continuous, to create a more competitive and business-friendly environment. The investment landscape has been clearly improved, and this is shown by the attraction of more international and strategic investors. The major transformation of Greece's production model has started with speed. We will see gradually the results, which are already visible, and this will be a long process. This has been reflected in the country's financial indicators, and before the outbreak of the Ukrainian and energy crisis in Greece, the country has shown a significant growth path. The structural reforms that have been implemented, especially in areas of digital transformation, have been significant. I would dare say that they're impressive, the digital transformation of the public sector, facilitating also the private sector and improving productivity. The process, of course, is continuous. The country also has given emphasis and supports innovation, while its strategy towards a green economic model put a strong basis for investments. As a consequence of the reforms, more financing option tools have been available for Greek-related businesses and investments that have not been available in Greece, although widely used in more mature markets internationally. I will mention briefly what types of liquidity exist overall in Greece currently. The long-term budget of EU funds of around 40 billion euros. As the Minister Skylakakis mentioned, the Recovery and the Resilience Fund, RRF, of euros 32 billion, for which a plan has been approved by the EU with focus on green energy, infrastructure, digital transformation, education, and not only. The attraction of foreign direct investments, the Greek banks, the cleanup of the Greek banks' balance sheets, and the reductions of NPEs have freed capital to focus on the financing of growth of the economy. In this context, I will mention the crucial role related to RRF and how all these funds will reach timely and properly the real economy. The major investment projects in key sectors of the economy, including the ones that are involved international investors, but also the SMEs. The banks have to make a big effort so this money will reach the real economy. Venture capital and private equity funds. First of all, Greek-owned funds new ones have emerged the last few years. Although there are still more significant prospects, we have seen substantial international private equity funds investing in Greek companies that have a dynamic model. We have quite a few success stories. Viva, CVC funds that have acquired NPLs, dynamic presence in real estate indicatively. This means that specific companies in Greece meet the strict criteria of the international investors, and I should also mention the high level of human capital and expertise that exists in Greece. The Hellenic Development Bank and the Hellenic Development of Investments, the new type of products that Vasiliki Lazarakou mentioned in the capital markets. I would like also to see stronger presence of foreign financial institutions in Greece to finance projects and finance international investors. Let me also mention that the regaining of the investment grade for Greece will attract even more investors in the country, as categories of funds that have currently restrictions due to their own specifications and investment standards will be able to invest also in Greece. Within this framework, the Greek government, and through the Hellenic Republic Asset Development Fund, apart from its primary role in privatization, has developed a new independent operational unit whose purpose is to mature, carry out the tender process, and supervise the implementation stage for projects. Now, do projects exist? Do Greek companies meet the investment criteria of investors? This is the next question. Investment opportunities do exist in a variety of sectors, indicatively, and as already have been mentioned, energy with emphasis on green energy and storage. The broader energy sector is and should be a key driver for investments and growth, as Greece is uniquely positioned, while companies such as Energean, which we will listen in one of the next panels, have started from Greece but shown an impressive international growth and been listed in the London Stock Exchange. Projects related to digital transformation in the private and public sectors, logistics, infrastructure, following also the Greek government announcement of various tenders gradually. Innovative companies, startups in various areas with a competitive extrovert model. Real estate and hospitality, including the opportunities that exist through NPLs, which may be also in the secondary market. Agri-food, education, pharmaceuticals, I'm sure we can find more opportunities in our various sectors. The presence of an investor can take, of course, the form of a joint venture, a direct investment, a joint venture with a local company, a direct acquisition of majority or minority stake. Listed companies and private companies with strong management, competitive strategic models have made steps and have the potential towards this direction. What investors will find attractive also are the ones that meet the criteria of corporate governance and ESG, innovation and digital transformation, and the ones that invest in education and have high level of human capital. In this context, I am optimistic that specific Greek companies have positioned themselves in this landscape, while increasing efforts is made by more companies, primarily listed, but not only. Representing the British Hellenic Chamber of Commerce, let me note also that I do believe that there are significant prospects of cooperation with UK companies to implement big projects. While London still holds the leading role in the financial market, needless to say, also in ESG innovation. I would like to see more international investors, representatives' offices, or in cooperation with local firms to be closer to the Greek market. Let me also emphasize the role of the Greeks working abroad. Some of them, you are here today. Not only the financial sector and the private equity venture capital, but you are the ambassadors of Greece, as your contribution in the initiation, in the implementation of financing projects and investments in Greece is crucial. Closing my initial remarks, I'm positive that money will reach the real economy, even with fluctuations, despite existing challenges. We are at your disposal, the Chamber, in cooperation with the Greek government and the British Embassy in Athens. And with this note, I will close my initial remarks. I'm looking forward to the discussion.
Thank you very much. Well, we have about 15 to 20 minutes for comments or discussion. I would just like to kick off with, you've all referred to, I think most of you referred to NPLs, and we heard earlier about banks, particularly in Cyprus. Do you think that your countries need to move away from relying so much on banks and more to private equity, venture capital, and of course some alternative investments? I mean, is that a general trend that you see pursuing, please?
Yes, this is a general trend. It's a global trend. And actually, I was discussing last night in a cocktail reception in the Greek embassy. EFAMA stands for the European Finance Management Association. I was in a webinar with EFAMA as president of CIFA, and the president of EFAMA stated very explicitly that he expects that the banking sector would be getting smaller and smaller, and the fund industry is going to booming in the following years. And this is a fact. In the US, 63% of new projects has been financed through alternative way of financing, including alternative investment funds. It's a global trend. We have seen this in Europe, not at the level of the US, but this is a matter of time. And I believe that because of there is liquidity with the banks, but they are reluctant to give new loans. It's much easier to attract if you have a very attractive investment proposition to attract alternative investment funds where they are looking to invest in this project, especially now. We have seen that even during the pandemic, there is an increase in the asset under management, and this is crucial. There is much liquidity with all the private equity funds and looking to find opportunities, and I believe that opportunities can be in projects in which there are NPLs.
I think, yes, you know my opinion that we have to go to complete the capital markets union, and that's why I said funding from Europe is not enough. And I believe that because capital market union can help exactly as an alternative means of financing the economy, not depending on the banking sector. In Europe, generally, not only Cyprus, they depend on the banking sector giving loans compared to the US, already mentioned. So we need to be more attractive as a Europe towards multinational enterprises and towards other big enterprises from China or from US. I mean, in Europe I'm talking, not only Cyprus. And that's why we need to complete the capital markets union and find other ways of financing the economy. We already have the fund industry, the crowdfunding now, and also now new regulations are coming in to facilitate the SMEs through the capital markets of raising capital with a much more efficient way and less burden, as I mentioned before, in their prospectuses or in their continuous obligations or in the market abuse issues that we have now. And also, we still need to do a lot of work on the data because the data are too much coming from all the regulations, too much data, and we are lost in the data up to now, right now, the regulators, I mean. And so they need to have artificial intelligence to help with the data. So technology will help to the capital markets to grow. So we need the technology in order to analyze using the technology or RegTech solutions or artificial intelligence solutions to help with all these regulations that are coming all the time. But at the same time, help the market with new products and services that will help also the SMEs to grow, not only the bank loans from bank lending.
You want to add anything?
Yes, I agree that both banks and the private equity and venture capital funds have their role. In Greece especially, the Greek banks have a significant role since through them the funds from RRF have to, let's say, to be approved in order to reach the real economy. So I believe they will have to be, even to modify their models of evaluation to incorporate the new challenges and risks that have to be, let's say, moderately not priced, but in order to give the opportunities to finance the economy. On the other hand, NPLs are not owned by the banks. They are managed by specialized entities and primarily foreign investors. So we have, and that's why the banks have decreased the NPLs ratios. But we have to see the efficiency of how these NPEs and in the secondary market especially will be managed in order to provide more value to the markets. Now, regarding the venture capital and private equity funds, as I said, the last few years have started actually to emerge. Some benefits and some incentives have been given, especially also from the Hellenic Development Bank and some other incentives from the Greek government. And I believe they will have increased interest from abroad. But the foreign venture capital and private equity funds are primarily interested in bigger projects. So other tools are necessary in order to finance the smaller and medium-sized companies.
If I can add something on what Demetra said about the data, and if we want to give the view of the NPL industry in Cyprus, we have to know that the NPL level now with the Cypriot bank is below 10%. Used to be 50, 60%. And we have seen investment funds investing not only in the underlying assets of the NPL, but directly in the NPL market. And especially in Cyprus, majority of NPL are now with international funds that they invest in the NPL market.
Any more comments or questions from anybody? In that case, I wanted to ask one more question, which was about inflation. I mean, I think most of you, indeed most of us, have really lived without inflation for many years, but it seems to be back. Is this difficult for investors and people raising money?
Indeed.
We don't know how long it will be here, but please, do you want to start, Demetra?
Okay. Yes, we've seen inflation the couple of last year and this year is continuing, even though they said that that would be not a permanent. I mean, that would be very short term, the inflation. But as we've seen, it growth to 5%, I think now, and maybe it will grow to 7% at the end of the year. So yes, it's a concern because now we have the goods increases in the price of goods, and also increases in the foil fuels, and also increases in probably in other goods that we don't know now, and that will create a problem with the SMEs and the people who that they don't can afford now to buy the necessities for the house. So as I heard in the morning, our Mr. Neophytou said that there is good to establish a fund from the EU again in order to help the countries, the EU countries, for this purpose, actually, to help the SMEs and the people that will be most affected by the inflation, as I understand. I don't know if this is going to happen, but so we expect the funding again from Europe to address the issue. I don't think the central banks will do any action in increasing the interest rates, not now. So the inflation will continue and see what to do.
Now, the big question is what will be the duration of the geopolitical crisis? Yeah. And even if, let's say, everything is solved, this does not mean necessarily that the impact in high energy, not necessarily that high, energy prices and associated consequences, how they will reach not the real economy, but the consumer and the smaller companies. In Greece, we have seen the last couple of months, even before the Ukrainian crisis, that energy prices have been increasing, but the companies, that in order to reach the consumers and not decrease the demand, have tried to absorb somehow this impact. Now they will not be able to do this. At the same time, the Greek government has tried, everything to support the individuals, the citizens, and the companies. But how long this will last and how this will impact gradually the economy and the financial indicators.
Yes, okay, I totally agree with what you said before. If I can add something, high inflation, we have the highest inflation in the last decades. It's important for the financial services industry. I can understand that would create issue with various sectors, including construction, including reduction in consumption. So there would be a cycle effect in the economy. However, for the financial services industry, and especially the fund sector, it creates opportunity because there are various funds that are invested in commodities. There are also opportunities through an investment fund and a proper diversification to create higher return for the investor, and you can hedge inflation through specific techniques to an investment investment fund. This is a one angle, but I think the most important is the fact that, yes, it will create issue with the global economy as well. I think the resilience fund is there to help, even though it was created for another reason, but as long as it's not fully utilized, I guess there will not be any other financial instrument in Europe. This is what was said by Finland and Holland, that we have first to utilize the funds from the resilient fund and then go to another financial instrument such as a fund or a bond. Hopefully, the amount that is within the resilient fund will be sufficient enough in order to help us with the cycle effect of higher inflation.
I would like to mention also that some investments will have to continue despite this current challenges condition, especially in energy, because this will facilitate to recover and to come out of this crisis, including in digital transformation. So the investments have to continue and very quickly in order to mitigate the effects.
What is happening in this country, and indeed in some other countries, is a lot of money is going into property, which isn't necessarily long-term benefit to the economy. I believe this happens in Cyprus as well.
Yeah. Yes, that's why I've said that it's more important to invest in green now, yes, instead of other sectors, because that will help us to not to be dependent in the fossil fuels. And try to be more greener. It will help generally the economy. I mean, not to be dependent in the Russian oil, for example. But this will take some time. It's not going to be this year or next year. It will take some time.
But the impression I've had from listening to previous discussions is that the loss of Russian finance and Russian investment is not as serious as I thought it would be well, particularly for Cyprus, but also to some extent for Greece.
This is not the case anymore. If I remember well, the figure from Central Bank some years ago, I mean, the deposit of Russia in Cyprus was to be 4 or 5 times more than what we have today. So there was an effort to diversify, to look at other markets such as Asia, India, Israel, Middle East. Obviously, now we need to move fast and trying to find other products in other markets in order to cover the loss that we're going to have from the Russian market. This undoubtedly it will have an effect in the Cyprus economy. I think it will not be a very critical effect in the economy, but we need to act fast and trying to find a kind of replacement market in order to cover from the loss of the Russian market. Because I totally agree with Mr. Neofitou, what he said in the morning, that obviously, even if the war is going to stop at the point of time, the economic crisis and the sanctions will be there for a long time.
Yes, and I think he also said that we're still going to have a growth rate, but not the same as we were projected before the war crisis. So around 3%, as I understand.
That's what he said, yes.
And in the fund industry, actually, because we have seen the data lately, we have only around 4 to 6% funds coming from Russian investors. So, especially for the fund industry, because I know the data, there would not be a serious effect because of the war in the Ukraine.
Great. Well, if anybody has any last questions, I could take one now. Otherwise, I think we'll break for coffee. And thank you very much to our 3 panelists. Thank you.